Hey everyone, Adil here, and welcome to the June Surroundup. The great debate of 2023, recession or no recession? Bull market or bear market? Soft landing or hard landing? The pundits continue to make their case and scratch their heads at the same time. I think this says it all.
On Wall Street today, news of lower interest rates sent the stock market up. But then the expectation that these rates would be inflationary sent the market down.
That is until the realization that lower interest rates might stimulate the sluggish economy pushed the market up, before it ultimately went down on fears that an overheated economy would lead to a reimposition of higher interest rates.
Confused yet? Okay, this may be a bit of an exaggeration, but it does sum up the type of environment we're in. This push-pull of opposing forces. You know who else is confused? The market, which hasn't been able to find a meaningful direction up or down in months. Coming into the year, everyone was sure the economy would fall off a cliff, followed by the market. Almost 6 months later, and we're still waiting. Meanwhile, the market has quietly climbed higher. The bears will say that the inevitable is simply delayed, citing slowing growth, tightening credit, negative earnings, cracks in the labor market, looming debt ceiling, and a market driven by big tech riding the AI train. The bulls will say that the consumer remains resilient, unemployment is at historic lows, earnings were better than expected, jobs are still being created, inflation is slowing, the bank crisis is behind us, and interest rates have peaked. Which argument will prevail? Only time will tell. In the meantime, let's turn to the book The Psychology of Money to offer some perspective. 1. Beware taking financial cues from people playing a different game than you are. In other words, the hedge fund managers, the market traders, the CNBC experts who are making the predictions are all playing a different game than you are. They need to either make money or headlines in the short term, so it matters what happens next week or next month. Ask any of these experts how they feel over the next 3 to 5 years, and I'm certain you'll hear a different tune. 2. Optimism sounds like a sales pitch. Pessimism sounds like someone trying to help you. Historian Deirdre McCloskey once said, "For reasons I've never understood, people like to hear that the world is going to hell." Look, there's always going to be something to worry about, but guess what? Historically, the market goes up about 75% of the time, so it's in your best interest to be optimistic. Now, don't confuse optimism with complacency. Optimism is a belief that the odds of a good outcome are in your favor over time, even when there will be setbacks along the way. And 3, diversification equals survival, and survival equals longevity, and longevity allows compounding to work wonders. Morgan Housel says it best. If I have to summarize money in a single word, it would be survival. Being diversified allows you to survive, and survival gives you longevity. Whether it's a recession, new highs, or some other event we don't know about yet, diversification prepares you for a wide range of outcomes. The ability to stick around for a long time without wiping out or being forced to give up is what makes the biggest difference. So where do we go from here? My suggestion, as always, zoom out, enjoy the weather, focus on what matters, and let us get lost in the economic weeds for you. That's it for this edition of the Surroundup. Remember, there's more than one way to wealth.